education and information webinars for Nadex every Monday night at 7 p.m. Eastern Time. So I appreciate you being here with us and hope you'll join us again in the upcoming weeks. If you've been with us over the last few weeks, you know we've kind of started over with our cycle of webinars here. We always like to cycle back every few months to make sure to catch up any of you that might be new. So we're always having new people that join Nadex and are interested in learning about Nadex binaries and Nadex spreads. So there's times where we get into really advanced systems and strategies and butterflies and iron condors and strangles, and some of you are saying I don't even know what any of that is, and that's okay. That's a little more advanced stuff. But right now we're kind of in the process of cycling back through over the basics. If you were with us over the last couple weeks, we talked about the basics of Nadex binaries. What is a binary? How do they work? What are they? What's the value of them? We talked about another webinar, the basics of Nadex spreads, kind of spreads 101. What are spreads? How do they work? What is the tick value, value at expiration, and so on. So if you have missed any of those webinars and you're not quite up to speed on some of the basics of binaries and spreads, we're not really going to be diving much into kind of the basics or 101 again tonight, because we did cover that over the last couple weeks. You can hop on to nadex.com and check out the webinar archives there, and you can catch up on those last few weeks of webinars to make sure you're up to speed and following along and catch up on any details of some of the basics that you might want to brush up on there. So let's jump in here tonight. Let me get our disclosures out of the way so we can get moving. Trading futures, options, or any financial instrument involves risk, may not be suitable for every investor. Any trading decision you make, your sole responsibility. Contents of this webinar are not an offer or solicitation of an offer to buy or sell any particular financial instrument offered by Nadex, and past performance is not indicative of future results. Speaking of Nadex, hop on over, if you're brand new, hop on over to nadex.com. You can get some great information there on the main page about the two different products that Nadex offers. They offer binaries and spreads. You get some great information there. You can also open a demo account. Nadex will give you a free demo account with $25,000 of demo money. That way you can get familiar with the Nadex platform, how to use it. We're going to be, here's a quick shot of the Nadex platform here. I'm going to be referencing this quite a bit tonight. So if you don't have a demo account already, go ahead and hop on right now and get one. It'll just take a minute or two. Get a demo account. That way you can follow along a little easier with us here. I'll be referencing the site quite a bit tonight, showing you some different binary options and some of the different prices and what that's all about. And so hop on and get that. Absolutely free. From there, hop on over to our website. Again, my name is John Skelton with apexinvesting.com. Apex is completely different from Nadex. Nadex is the exchange. Apex, we're an online group of traders helping traders. We're an education company. You can hop on over to our site, apexinvesting.com. You can sign up, get a free basic membership. Just create a username and password. It'll give you access to literally hundreds of hours of free education. We've got step-by-step training courses on binaries and spreads. And I don't mean just a quick webinar or a long webinar. I mean a laid out literal training course of everything you need to know about binaries. What are binaries? How to trade them? What are some different trading systems? You can see the trading systems and indicators that we use to trade, show you live trades, a little bit of everything. Bunch of strategies and systems, some news calendars, some free deviation levels, free binary and spread scanners. We show you how to get some charting platforms for free data, live data for futures and Forex. Tons of information over there. So hop on over and check that out. While you're at it, go to facebook.com/apexinvesting. Like us and follow us on Facebook. Once you've liked us, you'll see a little button that'll pop up on your page that says liked. Go ahead and click that and go down here to all posts. That way it'll make all posts visible. This is just a really great place to keep up. We post a lot of good information on here as far as new webinars that are coming up, new trainings, new strategies or systems, some screenshots of live trades from our trade rooms. Just a great place to keep up with some good information. So tonight, we're talking about choosing the right binary for your strategy. A lot of people say, okay, hey, I was on here a week or two ago. I understand the basics of a binary. I get what a binary is and how it works, but there's so many different ones, I'm still not exactly sure which one to choose. It feels like every time I enter a binary trade using whatever strategy or system I'm using, it just doesn't work out for me. It doesn't expire in the money, or it's not profitable. But then I hear other people talking about how they took the same trade and they made money. Like, how are they making money and I'm not? Well, it could be an issue with your strategy or system, sure. It could be that you don't have a great strategy or system, or it could be you have a great strategy but you don't quite understand the rules, or it could just simply be that you're choosing the wrong binary. Okay, and that's one of the common mistakes and probably one of the biggest mistakes that I've seen new binary traders make. And I'll be straight up with you, years back when I first started trading them, about 3 years ago, 4 years ago, that was my biggest mistake as well. Is I had a pretty decent strategy using one of these Apex strategies, but I was always choosing the wrong binary. And so I've been there myself. So we're going to talk about choosing the right binary. See what right there, OTM, ATM, ITM, what is that? Well, if you're familiar with options, you know what that means. OTM means out of the money, ATM means at the money, and ITM means in the money. That's the 3 different type of binaries out there that we're going to talk about. Okay, and we'll talk a little bit about expirations and time decay and premium and so on. Like I said, we're not going to be spending a whole lot of time tonight on the basics of binaries. You can catch up on those from the last couple weeks here on the archives. Okay, but just real quick, let me just pull back over here to the Nadex platform. And right now, let's look up Forex Binaries. You see we've got a bunch of different ones to choose from. Let's check out the euro dollar here. You see we've got some expirations, some binaries that opened at 6 p.m. They expire at 8. We have some that open at 7. They expire at 9. Let's take a look at some of these here at 9 o'clock. Okay. So these are the binaries that expire at 9 p.m. Right here, see this list here of strike prices. We've got 1.1304, 1300, 1296, 1290. Each one of these are what's called a different strike price. And each one of these strike prices is a different binary option contract. Okay? All a binary option contract is simply saying a statement. And it's binary. It's yes or no, true or false, 0 or 1. It will happen or will not happen. It's yes or no. And that's all a binary is. It's very simple. All right, this binary contract right here states, for example, the euro dollar will be greater than 1.1276 at 9 p.m. Eastern Time. Any time frames you see listed on the Nadex platform are in Eastern Time. That's it. That's all a binary is. Let me open up the ticket. This binary contract is simply a statement saying the euro dollar will be greater than 1.1276 at 9 p.m. It's either yes or no. If I think yes, that statement is true, whatever strategy or system I'm using telling me that the market's going up or the market will be above that. If I think it's true, I say yes, then I want to buy it. If I say no, I don't think it'll be true, I think the market will be under 1276, then I want to sell it. So buying is saying true, selling is saying false. And that's really it. That is what a binary contract is. Now, at expiration, whatever you buy or sell the binary for, at expiration, a binary is either worth 0 or it's worth 100. And so if you chose the proper direction of yes or no, true or false, buy or sell, if you were correct, at expiration, if you were correct, that binary contract is worth $100. If you were incorrect, it's worth 0. So your profit or loss is based on how much you bought or sold the binary contract for. So if I were to buy this one right here for $46.50, or let's say I was going to buy this one right here for $81, and it expired true, well, then it would be worth $100, and I'd have made $19. If I were to buy this one right here for $9.50, and the statement expired true, well, I bought it for $9.50, it expired worth $100, so I made $98 or $99 and, well, now 90 bucks. Okay, so that's a binary option. Now, but notice there's a bunch of different ones. Okay, and you've got all these different strike prices. Here you have the offer side, meaning what you can buy the binary for. Here you have the bid side, meaning what you can sell it for. Okay, these up here don't have a bid. These down here don't have an offer. So you can't buy these, you can't sell these. All right, these are so high up there, you'd be paying over 99 bucks to buy one. The most it's going to be worth is 100 bucks. You wouldn't want to do that. But there's so many different binaries here. Why are they priced so different? Why can I buy this one for only 6 bucks, but this one I can buy for 98 bucks? Why is there such a big difference in price? And a lot of people say, oh, well, man, I can buy that one for 8 bucks and I'm only risking $8. If I lose 8 bucks, not a big deal. And if I'm right, it's worth 100 bucks. So I'll make $92. I like those odds, right? Sure, we all like that risk to reward ratio there. We like that potential return. But we have to look at not just potential, but also probable. All right? That's a great, you could potentially have a great reward there. But what's the probability of actually having that? Okay, so we want to talk about why there's so many different binaries and why you would want to choose one over the other. And like I said, for a lot of people that are struggling in binaries, it's normally because they're choosing the wrong one based on what strategy or system they're using, or just based on a simple misconception of how binaries work and why there are different ones. Let's go ahead and take a look here at these 8 o'clock ones real quick. Okay, so let's take a look. First of all, we're going to talk about what's called an at-the-money binary, or ATM binary. Take a look right here. What is this binary contract stating? Stating that the euro dollar will be greater than 1.1267. Okay? See this right here, Nadex indicative index? Okay? That is stating, you can see it also right here, that is stating where the market is right now. Okay? Right now, the market is at 1266. This contract says that it's got to be above 1267. So this contract strike price is right at where the market is right now, right? It's very, very close. The strike price is very close to right where the market is. So it's kind of right on the fence there, right? It's kind of 50-50. The market could expire above 1267 or it could expire just below 1267. We're kind of right on the fence there. Does that make sense? So at expiration, it's got to be one or the other. And the value is going to be either what? 0 or 100. So what is right in between 0 and 100? Well, $50, right? So that's what's called an at-the-money binary, meaning when the binary strike price is right at where the market is right now, you can count on your binary currently being priced around what? You can sell it for 44, buy it for 53. What's the midpoint? Right close to $50. Okay, that's what we call at the money, because it's right there at the money. It can go either way. That's why it's priced around 50 bucks. Let me show you another example. Notice here that these expire at 8 p.m. Right? 1267, 1266.9. Like it's basically at 1267. That's why it's priced around 50 bucks. Those expire at 8 p.m. tonight. Let's take a look at 9 p.m. tonight. All right, what do we have here? We have a strike price of 1268 and the market's at 1266. Not quite at 50 bucks, but close, right? Let's take a look at something that expires hours from now, like in the middle of the night at, let's say, 3 p.m. Or let's even look at 7 a.m. tomorrow morning, almost 12 hours from now. Well, these strikes are a little wider. They're 20 ticks wide. See, we got 1260, 1280, 1300. Well, 1260 would be the closest one to the current market of 1266. And see, 54 and 60. Okay, that one's not quite right on because it's such a big width. But notice these down here that are priced at 94, 99, or these up here at 5. The one that's right closest to where the current market is going to be the one closest to 50 bucks. Today is Monday. All the new contracts just opened up late last night. What about the weeklies that expire on Friday, like days from now? Well, the closest strike is this one right here that expires on Friday at 1275. That's the closest to 1266. Look about where it's priced at. Close to 50 bucks. Okay, so does that make sense what an at-the-money binary is? Because at expiration, it's got to be one or the other. It's got to be up here at 100 or it's got to be at 0. So when the market's right close to that strike, we don't know yet, right? It's kind of right in the middle, so it's priced around 50 bucks. That's what's called an at-the-money binary. Any questions on that in and of itself of an at-the-money binary and why it's priced at 50 bucks? All good? Okay, so if I was to be trading at the money binaries, I would be risking about 50 bucks to potentially make 50 bucks. So it'd be about a 1-to-1 risk-reward ratio. All right, so now when you're looking at all these different strike prices on Nadex, now that you kind of have a basic understanding of what an at-the-money binary is, kind of helps you understand a little more what you're looking at as far as all of these other binaries and why they're priced the way they are. So let's take a look here at some of these at 9 o'clock. So now that you know that, when you're looking at all these numbers, they're not quite as scrambled anymore as they were, right? Because your eyes go right to, boom, around the $50 range. So what does that automatically tell you in your head? Okay, right in here at this strike is about where the market is, right? Okay, well, why are some of these up here priced so much cheaper? Why are they priced less than 50? Like this one right here, 16, I can buy it for $16.50. Well, let's click it. What is this binary contract stating? That the euro dollar will be greater than 1.1276 at 9 p.m. Okay, 1276. Where's the market at right now? 1267, right? It's 9, the market is 9 ticks below this strike. So if I was to buy it, what am I saying? Okay, I'm buying it saying, yes, the market will be greater than 1276 at 9 p.m. Well, what does the market have to do? The market has to go from 1268 up to 1276. The market has to move, and the market has to move up. So it's not quite the same probability that that's going to happen. If you go back and you watch the basics of binaries, you will hear me talk about probability percentage. If I look at these two numbers right here and say, okay, I can buy this for 21 or I can sell it for 12.50. If I add those two numbers up and divide it in half, what's right in the middle? About 16 bucks, right? 16 bucks is the midpoint between those two prices. You can, if you figure out that midpoint, you can kind of look at it as a probability, okay? Because based on the price of the option, it's kind of telling you just in and of itself as a standalone number without looking at charts and indicators and knowing what direction the market's going, just in and of itself, about a 16% probability that this binary will expire profitable above 1276. So you can kind of look at those prices as probability, the midpoint. So, hey, I like the fact that I can buy this for $18.75. I'm only risking 18 bucks. I can potentially make 81 bucks. We like that, don't we? We like that risk to reward. But do we really like a trade that only has a 16% probability in and of itself? So you can't just look at your risk and reward. You have to also look at probability, right? Because just run the numbers, all right? If all you ever did was just come in, like I said, this right here is the biggest mistake that new binary traders make. Because they go in here and they say, okay, well, I can buy this one for 76. Ooh, I don't want to risk 77 bucks. I don't want to risk 50 bucks. Oh, I'll risk $9. Let me just throw that on. And then they wonder why they're losing money. Because they're like, man, all I got to do is just win one trade and I can make 90 bucks. So there's no way that I'll lose. I got to be profitable. Really? Think about it. What's the midpoint between these two numbers here? About 5, 6? That's a 5% probability of winning. That means you'll win 1 out of 20. So if you're risking $9 20 times in order to one time make 90 bucks, run the math. It just doesn't work, does it? Okay? Now, I'm not telling you to never use these cheaper binaries here. They have their place, but they have their place when you have something on your chart, on your strategy or system telling you the market is moving up. They don't work just to randomly go in and buy them because they're cheap and because I can handle losing 8 or 9 bucks. Well, you'll lose 8 or 9 bucks all day until your account is gone. Trust me. Okay? So let's take a look at this a little bit differently. All right. Let's look at the euro dollar. All right. This strike right here is what? 12.80. It's only priced at 9.50. Let's look at a chart. Let's look at a euro dollar chart. Okay? And I'm sorry, what was it? The strike price was 12.80. Okay, so right now the market's right here at 12.68. Okay? 12.80 is way up here. See that? 12.80 is way up there. So right now the market's at 12.68. If I was to buy a binary that had a strike price of 12.68, how much approximately would I pay for that binary? If there was a binary strike price right there, or strike right there where the market is at 12.68, how much would I approximately pay for that binary right now? Exactly. I'd pay about 50 bucks because it's right at the money, because it's kind of 50-50, right? If the market expired one tick above it, it'd be profitable, worth 100. If the market expired one tick below it, it would not expire and the money would expire, worth 0, right? So it's right at the money. So that's why it's a $50 risk, because it's about 50-50. Why do we think this one up here is priced at $9 and I can buy it? Because what does the market have to do for that one to expire profitable? The market has to move all the way up there, right? It's a lot higher probability for the market to expire one tick above where it is right now, right? It's a less likely probability that the market will go all the way up here, unless I have something telling me the market's moving or there's news or whatever. All right, so that makes sense. Does that make sense as to why some of those binaries are priced so cheap? Because it's not as high of a probability. So yes, you're risking less and potentially you could make a lot more as far as your ratio, but the probability is very, very low. Okay? So does that help a little bit there? Because a lot of you, especially newbies, you look at this and you go, man, there's all these different ones and these different prices. Which one do I do? I'll just take a cheap one because I don't want to risk a whole lot. Well, you can understand how just randomly taking a cheap one over the long run could mean throwing away a lot of money, right? Okay, so now it starts to put into perspective when you look at these prices and these strikes, where's your eye go to right away? Boom, the $50 range, right? And what does that automatically tell you in your head, even without looking at a chart? It tells you, okay, the market's about right here. If I'm going to get one of these other ones, I'm saying the market needs to go up. If I'm going to sell one of these other ones down here, I'm saying the market needs to go down. It kind of puts this into perspective where it's not as overwhelming and confusing. You go right to that $50 mark. You know that's where the market is. You know that these are cheaper for the market to go up. Now let's take a look at something different. We understand 50-50, right in the middle. We understand why some of these are cheaper. But now let's look at this one. This one is priced at $74. So if I were to buy that one, I'd be risking 74 bucks, and if it expired in the money, it'd be worth 100, so I could make 26 bucks. And what's going through all of your heads right now? Your very first initial gut response, kind of catch your breath, ooh, 74 bucks. I don't want to risk 74 bucks. I don't want to think in my head that between now and 9 p.m. on one binary, I could lose $74 all because of one tick, right? Well, why is it priced at $74? Let's take a look. What is the strike price? $12.64. Okay, let's look at the chart. Where is $12.64? $12.64 is right here. Right? And the market's at 1267. So what is a binary? A binary is just a statement, right? A binary is simply a statement. Hold on, I want to tear this off real quick. Tear off ticket. So what is this binary statement? That the euro dollar will expire greater than 1264. The market's already greater than 1264, isn't it? So it's already, the statement's already true as of right now. So as long as the market stays above 1264, this will expire in the money. Remember this one up here at $10. What's the only possible way for that one to expire in the money? The only possible way. What would have to happen for this one to expire in the money? The market has to move. Absolutely has to move, right? And the market absolutely has to move one direction, which is up, right? Those two things have to happen for that binary up here to expire profitable. The market has to move enough, and has to move up, and it has to do all that by 9 o'clock, right? Well, that's why it's priced so cheap, because it's a lower probability. Why is this one priced so high? What are the options here? What if the market right now just went dead? Like no heartbeat, went dead, didn't move at all between now and 9 p.m. It just went flat and stayed right where it's at. But you had bought this binary at 1264. Would that expire profitable? Worth $100? If the market just went flat and stayed right where it is, would this 1264 expire profitable? Yes, it would, because it's already a true statement. If it went flat and went dead and stayed where it is, this one would expire worth nothing, right? But this one would expire profitable, even if the market went flat. All right, scenario 2. What if the market went up? What if the market went up and expired somewhere above here at 9 p.m.? would this one expire profitable or not profitable? Yeah, it would still expire profitable. What if the market went down and at 9 o'clock the market came down here and it expired at 1265? Would that binary at 1264 still be profitable? Yeah, because again, it's just a simple yes or no. Okay, so does that help put it into perspective a little bit more when we draw it out on the chart like that? Okay, now it makes a little more sense. I understand why something's priced at 50 when it's right at the market. I understand these cheap ones up here, okay? These cheapy ones up here for $5 and $6 and $8 and $10, those cheaper ones, the reason they're so cheap is because they're way up here. And the only way to make these profitable at expiration is the market has to move. It has to move one direction, and it has to move all the way up there, and it has to move all the way up there by 9 o'clock. That's putting a lot of ifs into that, right? That's putting a lot of scenarios into it. So that's why it's so cheap. That's why it's a smaller risk and a higher potential reward, because it's a longer shot, right? The reason this one right here is priced at $24, or I'm sorry, $77 now, is because you have a lot more options with that one, don't you? The market can go flat and not move. The market could go up and you're good. The market could even come down. But as long as it doesn't come all the way down under your strike, you're still good. You have a lot more options and you have a lot higher probability. Remember we talked about the midpoint. What's the midpoint basically between 81 and 72.50? What about 77, 76? So this particular binary contract has a 76% probability in and of itself, as opposed to this one here that I can buy for 10, sell for 2, what, 8%? Okay, or let's even look at this one right here. This one I can get for 20 bucks or 11, so, you know, call it 14, 15%. So just looking at the probability aspect, we're not talking about strategy and system and where the market's going. We're just talking about the price of the option. So in general, if you're looking at a trading strategy or system, are you going to be more drawn to a trading strategy that has technically a 15% probability or more of a 70% probability? I think we all know the answer to that. From the probability side of it alone, we're all going to prefer a 70 or 75% probability over a 15%. Everybody follow me on that? Is there any questions about what I just said right there or explaining the probability? Any questions at all on in the money, at the money, and out of the money binaries? Before we move any further, let me ask that. Now's your chance to ask questions. If any of that didn't quite follow, let me know real quick here. Okay, Terry got understood in the money. Okay, perfect. All right, so I think everybody's good here. So let me just get rid of, or no, let me get rid of these drawings real quick. And let's remove that. So let's just be real here, okay? We all know the answer. I'm asking some elementary questions. all of us prefer a 70% probability as opposed to a 13% probability, right? We all know that. That's a dumb question. Everybody's going to always say, I want the 70% probability when you're just looking at probabilities. Now, what do we not like? Well, we don't like, I love this probability. I love 72% probability. Love it. What do I hate? What freaks me out? Right there. My maximum loss of $77. Right? That's what I don't like. I don't like the feeling of risking $77 to only make $22. Right? Does everybody agree? We love the 72%, but we don't like risking 70 to make 22. That's what we don't like. What we do like is even this one. Hey, I can risk 33 to make 66. I like those odds. Give me those apples all day long, right? We like that. We're great with that. All right, or this one, man, I can risk 16. I can risk 16 to maybe make 83. Love that. Like we totally love that. But it's 13% probability. So in an ideal world, what would we love to have? We would love to have a combination of the two, right? We would love to say, man, I'd like to be able to get a 72% probability, but only risk 32 bucks. Like that would be great, right? If we could get the high probability, but lower our exposure of risk. Does everybody agree with that? That would be the ideal world. Okay, so, and Naren, I saw your question. I'm not avoiding it. Let me get through this and I'll go back and answer that. But that's a great question. I'll definitely get to that. So, how can we possibly maybe create that? How can we maybe create that world for ourselves? And that's what I want to talk to you about here, okay? And then we'll kind of wrap it up and bring this kind of all together here for you. So let's look. Remember this binary that we've been looking at, 1264, and I could buy it for $78. All right, well, where is 1264 again? Right there. Okay, now let's look at this one that we looked at that's at $33. If I bought that one, I'm only risking $34 now. That's at 1272. Where's 1272? 1272 is up here. Okay. All right. So if I buy this one up here, I'm risking 34 bucks, right? Okay. And we know that for this one to expire in the money, what does the market have to do? Technically, it has to do three things. It has to move. It has to move up, not down. And it has to move up here by 9 o'clock. We know those are the things that kind of restrict us, right? Or the things that all have to line up in order to make this one profitable. So I'm risking $33 up here because I like that risk. What do we not like about it? The low probability. Okay, this one right here, we bought for how much? It was like $76. It was priced at a minute ago. $77. All right, so I'm putting up $77 to buy this binary. The market can stay where it is. The market can go up. The market can even come down, but as long as it doesn't come to my strike, I still make money. Now, everything we've talked about so far is at expiration, meaning, okay, if I bought this one and I held it all the way to expiration, it's worth 0 or 100. But with Nadex binaries, you don't have to hold them till expiration. You can get out early, meaning you could get out early if you bought a binary and the market's going up and the profit's going up. You can get out early and take whatever profit's there. If you bought a binary and the market's going down, you're losing, you could exit early and not take a full loss. You can get out early, right? So we bought this one for 77 bucks. We've got a lot of options. The market can stay flat, go up, come down. What would happen if we bought this one right here for $77 and the market, and we were wrong, the market comes down and it comes down and it comes down, and before expiration, I'm not talking about at expiration, I'm saying we buy it and between now and 9 o'clock we realize we're wrong, the market's coming down, and the market comes all the way down to 1264, meaning it comes all the way to our strike price. What do we call that binary now? Is that an in the money binary, or what's it called when the strike is right at the same as the market? We call that at the money. And what do we know that an at the money binary is going to be priced at approximately? I showed you an example of 8 o'clock tonight, 9 o'clock tonight, 7 a.m. tomorrow, and even days from now on Friday, that we know with binary options when the strike is right at the market, it's worth approximately 50 bucks. So if I bought this binary for 77 and my strategy was to say I'm buying it for 77 because it's a high probability. The market can stay right where it is, I win. The market can go up, I win. The market could even come down a little bit, I win. But if the market comes all the way down to my strike and hits my strike, I'm going to exit. So I bought it for 77. I can get out of it for around 50. So how much did I lose? What was my risk? If I stuck to that plan, how much money did I truly risk and lose? If I bought for 77, got out of it at 50. I lost 27 bucks. $27. What did I pay for this one up here, this out of the money? 34. Remember? Yep, Terry, right. Yep, the out of the money one up here, I risked 34. So what did I just do right there? I limited my risk. I got into something around 75 bucks, 77 bucks. Why? Because I wanted the high probability. I wanted the 70% probability. I wanted the options of letting the market sit flat, go up, or even come down a little bit. I wanted the higher probability and the more flexibility. So I was able to get this one here. And with a strategy of saying, if I'm wrong and it comes all the way down and hits the strike, boom, I'm getting out at 50 bucks. So I really only risked what? About $27. About the same risk as the cheapy ones up here, but I had a lot higher probability. Okay? Does that make sense? Sam brings up a good question. Why 70% then? Why can't we go 85%? Sam, that's a perfect question, and thank you for asking it because you totally set me up here just right. What does Sam mean by that? Well, what Sam's saying is, man, that makes a lot of sense. Those higher probability. Why did you limit yourself to around 70%? Let's look at, hold on, let's give ourselves some more options here. We look at some different ones. What Sam is saying is, hold on here. Let me find a better example than what we're looking at. Let's try Euro Yen. There we go, right? Sam's saying, okay, $69 there, about 70%, cool. What Sam's saying is, hey, why don't you take that 87 one, the 86 one, because that's even higher probability, right, Sam? It's a higher probability, and not just that, but what Sam's also trying to point out is, hey, you got this one here at 70%. What if you can get one down here that's 86% and give yourself even more room to be right? Right, Sam? That's where you're going with that? Because not only is it a higher probability, but if you could get it down here even lower, you're giving yourself a lot more room. And I totally get that question, and everybody can see it. Sam's right. 86% is higher than 70. Getting a strike further down here gives yourself more room. Absolutely it does. And I'm not going to tell you to not do that, Sam, but here's the other aspect of this. Here's kind of the final touch of this. In the scenario right here, just to make the numbers easy, let's say we bought this for 75. Okay? If I buy this for 75 bucks and I discipline my strategy that if the market comes down to this strike, I get out at 50. So what do I lose? If I bought it right there for 75, the market comes down to my strike, I'm disciplined to get out at 50. So I lose 25. Right? Everybody follow me? If I'm right, if I buy this for 75 and I'm right and the market expires above it, how much do I make? Well, the most a binary can be worth at expiration is $100. So if I bought it for 75, I can make $25. If I follow my rules and I get out at 50, I lose $25. So what did I just make for myself right there? I made a 1-to-1 risk-reward ratio where I'm potentially able to make 25 or lose 25. So if on every trade I make, I'm either going to make 25 or lose 25. Well, as long as I win more than 50% of the time, then I come out profitable, right? So what I created for myself was a trade with a 75% probability, but a 1-to-1 risk-reward ratio. So as long as I'm winning more than 50% of the time, I'm making out. Does everybody follow that part right there? So Sam, to answer your question, Sam is right. Getting one of these further down here does give you more room. But if you bought this one for 86 bucks, Sam, the most you could make is $14. If you got out at 50, you'd be losing $36. So you're technically, your trade plan there technically is risking 36 to make 14. Okay, it kind of puts you a little upside down on the risk to reward ratio. Granted, it might have a little higher probability of winning, but you kind of got to weigh those two out and balance them together. Does that make sense, Sam? I'm not saying don't ever do that. I do trades like that all the time. I call them what I call them is EPCs, meaning expiration premium collection, where if there's not a lot of volume in the market, it's not real volatile, it's just sitting there, kind of like what's happening right now, you know, then I might, and there's no news coming out, there's no economic events coming out, you know, there's nothing on my chart or indicators or strategy or system telling me the market's moving, other pairs aren't moving. Yeah, I might go down there and get that one just because it's higher probability and not much going on. Okay, so does that help clarify a little bit? When you look at these things now, when you look at binaries and you see all the different ones and all the different prices, is it a little less confusing as to what it all means? Okay, and can any of you now say, ah, I totally see why I've been losing money with binaries, because all I'm ever doing is buying the cheapest one I could find because I like the risk reward. And now I realize why they're losing a lot, because I'm just buying some cheapie without even knowing that the market's moving. Now, let me clarify a couple things here, and then I'll make sure to get to all these questions. I am not telling you to never buy an out of the money binary. I'm not telling you that these cheaper ones at 20, $10 or $22, I'm not telling you that those are bad and they're always bad, stay away, never use them. I am in no way saying that. I'm just saying you don't want to just randomly, again, the biggest mistake people make is just, oh, I can only risk 10 bucks and maybe make 90. I'll do it, click. And I'm not looking at a strategy, I'm not looking at a system, I'm not looking at a chart. I'm just choosing a number based on the odds. Do you know what you call that? You don't call that trading. There's a word for that. A lot of it happens in Vegas. Yeah, it's called gambling. Like you're not trading. If you're just randomly picking a binary because you like the number, that's just gambling. Don't do it. Go to Vegas if you want to gamble. Have fun. See a show. Get free drinks while you're losing a little bit at a time and just randomly throwing money out there. You know what I mean? But it's gambling. But if you have a strategy or system that you're using that's, giving you a direction that, hey, the market's going up and there's news coming out and you see that there's some volatility and volume in the market and you think, hey, there might be a pretty good move. I might go ahead and take one of those out of the money strikes. Now, the other thing is, let's say I bought this one right here for 18 bucks. And the market does start to go up. And all of a sudden this one for 18 bucks is worth 25, and then it's worth 30, and then it's worth 40, and then it's worth 50. I can get out of it right then. I can buy it for 17 and get out of it when it reaches 40 and make some money. I don't have to hold them all the way till expiration. I can get out of those early too and kind of scalp them, as it were, right? Buy it for 17, get out of it at 35 or 40, take a little bit of money off the table. I don't have to hold it all the way. So there are times when you do, maybe want to use these binaries, okay? But you only want to use them when you're doing what the chart's telling you to do, okay? When the market is moving, all right? Okay, let me check on a few questions here, because I know there's a couple. If you bought for 12 over 10, the market goes to 25, so price 2, but under that, do you make money? Let's see here. Yeah, Naren, I think that answered your question there. If you do buy something for 10, 20, 30 bucks and it goes up, you can hold it to expiration or you can get out of it early. If I buy something for 30 bucks and it goes up to 60, I can get out at 60 and make 30. Like, I don't have to hold it. If I see the market is going up, but if I bought a binary way up here, the market's starting to go up there and it's increasing in value, but then the market starts to slow down, I can just get out and take what money's on the table there. Okay? I don't have to hold it. Let's see here. Ron, but you can get out when it hits one exit point, then it could run the other direction, hit the other one, also losing both trade. No, Ron, you're right. I mean, you know, in the example I gave of, okay, if I buy a binary right here and I'm wrong and the market comes down to my strike, I buy this for 75, the market comes down to my strike, so I get out at 50. And the market comes down a little further, oh, then it goes back up. Oh man, I should have stayed in it, is what you're thinking. Well, would you rather follow your strategy, be disciplined, keep a 1-to-1 risk-reward ratio, risking 25 to make 25, or potentially be wrong and lose 75 bucks every time? I mean, I get your point, Ron. Yeah, it could hit that, your stop, and then come right back. But how many times is it not going to come back and you lost 75 and wished you would have just stuck to your 25 and 25? You know, it can definitely go both ways there. Okay. Let's see here. Sam, bid ask why. Yeah, at night, especially when there's no volatility like that, it's going to be a little wider. That's just how options work. You know, if there was volume and volatility, or even during the daytime where there's, you know, more going on, it's a little wider. But that's how any options work, not just binaries. You know, depending on the volatility and what's going on, that bid ask can be a little wider there. Having to buy and sell and lose. Oh, Ron, you're talking about like a butterfly, where I bought this one here and then sold one up here, saying that the market will expire within the range. Yeah, I mean, it is possible that that can happen. The way I do butterflies, and we don't have time to get into it too deep tonight, but if you go to the Apex investing site, under the binary section, there's a butterfly section there. What I normally do there, Ron, is I exit both sides when it hits one. Meaning, if I had butterflied this, meaning I sold it in the money up here and I bought it in the money down here, if the market comes down here and hits this, let's just say, Ron, say I bought this one for 75, I sold this one at 25, and the market was right in the middle. Well, if the market came all the way down, that's going to make this one be even more in the money, right? Let's say I sold it for 25. Now it's gone down to, let's say, like 10. So it's like $15 profitable on this side, right? Because the market went down. So I've got like $15 profit here. Granted, as soon as this one hits, I'm going to exit it for 50. So I lost 25. But I made 15 over here, so I really only lost 10. So yeah. Does that make more sense, Ron? That's how I do butterflies. I don't wait for it to hit both. Exactly, so I don't have the issue you were talking about. If one side hits, I close them both. And losing 25 here doesn't hurt as bad when it, you know, I made 15 here, so I really only lost 10 with a potential profit of 50. So I might have lost some of you there with butterflies, but check out the Apex Investing website there under the binary section, and it'll explain butterflies just a little bit more. So, all right, guys, I hope that helps. We're over our hour here, so I'm going to let you run. Plus, I just had a huge wind, rain, and hailstorm that is hitting my house here like crazy, and my power's flickering, so I might lose you guys. But hope that helps you tonight. Hope that helps clarify a little bit with binaries and what they are, and how they work, and helps you maybe choose the right one and maybe realize that, that's what's going on. I'm choosing the wrong ones. And showed you a little bit there how to combine lower risk but with higher probability. And maybe you see now why I started off the whole webinar talking about the at-the-money binaries being worth $50, whether they expire in 30 minutes, 3 hours, or 3 days. That's the confidence you have of knowing that the at-the-money be worth around 50, because you know you can use that as a stop for yourself on those in-the-money higher probability trades. So Anyway, hop on over to apexinvesting.com. Check us out over there. Open a free account over there to get all the education and info on some charts and strategies and systems. Bunch of free stuff there for you. Hop on Nadex, get a free demo account, and we will look forward to seeing you next week and each and every Monday night at 7 p.m. Eastern Time. Thank you so much for being on and for your great questions. Thank you, Craig. I appreciate it. We'll see y'all next week.